Okay, so welcome back everyone to an exciting 2022. Last year was another excellent year for Cashbox Global and our investor community, and we're wishing you all a profitable year ahead and look forward to sharing the journey with you. For the new attendees that are here today, my name's Jill and I take care of the community and their advisors. Andrew and Chad are going to introduce themselves during the course of the session. And again, please feel free to ask any questions during the session, or if you prefer, you can just post them in the chat and we can answer all your questions. Today's session is on the BBVA Fitness Fixed Income AutoCall note, which is a little different to what you've seen before. And Andrew's obviously going to go through it and Chad will also go through parts of it. Remember that we don't offer any advice. This session is product information for education only. And we encourage you to always do your own research and due diligence before making any kind of a decision. So with that, Andrew, are you around or?
Yes, I am. You can switch. I'll put on video now. I'm just entering the office in a bit of a mad rush, but I'm here.
Fabulous.
Cool.
Okay, let me know when I must move along. Give me a tour of Andrew's house.
Okay, there we go. Right.
Andrew, are you okay?
Yeah, can you see me?
100%.
Okay, fantastic. Okay, welcome everybody. Yeah, just to echo what Chad said, Happy New Year, but belated, especially to some of the guys and ladies who are out there who've been fighting with the dreaded pandemic. Graham, who you met just a short while ago, obviously the latest victim, but as he said, going to stop him getting out to SA. That's so right. Yeah, Ray, thanks. I think in putting this product together with IDAD, you know, we've had the benefit of really, really strange times that we've all lived through. And you know, 2019 saw the end of a great bull run, and obviously what happened was 2020 was a very strange year, and 2021 was in some ways also strange because of the great rebound. So what I thought I'd do in terms of today's presentation was to more have a little look back, but that's one thing, that's easy to look back, but look forward in terms of what new stresses and strains are we going to be facing. I think that's the key. Because from these strange times, we actually are moving into perhaps a more normalization of traditional criteria that we should base our investments on and our thinking. And what I mean by that is that the world was pulled apart by COVID and continues to be so. But as the pandemic slowly ebbs away, as Chad said, hopefully this goes away completely, and I think it'll always remain with us in some shape or form. But I think there's a consensus, globally, politically, and in the economic environment that it is going to be complex in 2022. And I would ask everybody, if they have chance and time, to have a look at on the website, the actual full economic rationale for where we are. This is not an economics 101 lesson. It's really just a reality check, a snapshot of where we are currently and what we're going to be facing this year. I think that's what's important, to look ahead and to sort of question, are we going to do the same old thing last year? Are we going to change certain things? And during the course of the short presentation, you'll see how we have started moving in certain different directions. And I think if we can sum it up, I think there's consensus that the impact of the pandemic is likely to ease across major developed and emerging markets in the year ahead in 2022. I think the whole, vaccine supply, the pros and cons and the arguments about it that was highlighted with the Australian Open and Djokovic, it really is quite contentious. But I think it's been proved that the therapeutic treatments will limit fallouts going forward and hopefully into the new variants as they emerge. And I think what we saw coming out of last year were some of the stresses and strains from really robust growth. In other words, the ugly word of inflation for the first time in maybe 2 years reared its head. The word of tapering, in other words, the cutting of the fiscal stimulus by various central banks to to the economic sort of areas of the world is going to start easing and stopping. The handbrake is being pulled up. I often say the party for free money is probably over to a large degree. And that's all come about because of the fact that the economies have recovered in a large degree in terms of growth. And I think what's also going to be coming out of this, and what has come out of it, and this has been very contentious, is that dreaded word inflation. Inflation is, something that is spawned as a byproduct of too hot growth, when things are going too well. And allied to the growth is that we saw what COVID caused. It was caused bottlenecks of supply all around the world. So in as much as companies were trying to get their product to market, they were either reliant on a subcontractor to provide a certain part, or logistics to get it from wholesale to retail. And there have been major bottlenecks around the world. Probably the most obvious one and the most highly written one has been about in the tech space, in terms of semiconductors, microprocessors, everything that makes our digital world go round and forward. But I think there is a consensus that at 2022 we'll see an easing of perhaps those bottlenecks, of some of those stresses and strains. But to come back to my original sort of opening paragraph, I think 2022 is going to be a more normal year. So these headwinds that we are going into, we didn't have last year and the year before. We didn't have inflation. We didn't have interest rates. They were absolutely benign, and there was great opportunity to do great things. It obviously, and I certainly during the year of 2020, from let's say the first 6 months and probably since then as well, you had to have an element of bravery to dip a toe and go into the markets. Many people sat on the side. There was a wall of money during the first 6 months of 2020, waiting to see what was going to happen. And if you look at, and we'll get to a slide shortly when we deal with that, you'll see how during that time it was quite comfortable for us to create really fizzy, exciting income-style notes. And as we progressed through the years, we'll see how things are changing. So 2022 is going to have, I would say, more normal stresses and strains, where one should look at economic and business fundamentals, earnings of a company. Are they important? Yes, they are very important, because during 2020, the rule book on earnings was just simply torn up and thrown out the window. Nobody could understand how a little company like Tesla could become the most valuable car company in the world by market capitalization, and so on and so forth. It was right across the board. It didn't make sense how these companies could be so highly valued, but it was money chasing money. And I like to use the acronym TINA, T-I-N-A. During 2020 and 2021, TINA was very much an acronym that was in vogue. And TINA standing simply for there is no alternative but equity. So asset classes as a whole were completely shook and shuddered by the 2020 pandemic. And equities really were the only place where you could make money, either being directly exposed with a strategy in terms of a segregated portfolio, or through ETFs, or via unit trust mutual funds, or via the instruments that we use in notes, which have exposure to those underlying investment stories. So I think 2022 is going to be more of a normalization of economic fundamentals. It's clear that interest rates are going to go up. Certainly in the UK, they've gone up, although very incrementally off a very low base. South Africa, many of us are sitting in South Africa. We're seeing that happen. The US didn't want to do it. I think they've got a very dovish Federal Reserve central bank who wanted to keep interest rates benign as long as possible. And they thought inflation was going to be what they use the word transitory. It's obviously sticking around. But I think as those bottlenecks of supply and demand ease, the economic fiscus, as it tapers down, I think there will be a raft of, I think there's consensus, will be a raft of increases, interest rate increases in the US, also of a very low base. So cash is still not paying you much, or if anything. And TINA is still sort of in play. You still need to be in the stock markets in one way or another. I think the difficulty in 2022, if you're in the stock market, is choosing with more ease. the winners of this year and beyond. It was quite easy during the 2020 recovery, when one realized that tech, we were moving into this digital work from home, modular space, very granular space, where everything became digitized and electronic and futuristic. We were living in the future, that those types of companies were going to do well. And we've got one in our blend tonight, which we'll go through quickly. So, I think there are some moderating forces this year. Last year, we saw some really great rates. The S&P on a whole produced around about 27% if you bought the index. But there were some big losers. So you were from the wrong time. If you were in the wrong place at the wrong time, in leisure or travel, or to some degree, the early days in terms of energy, it didn't go well. So, yeah, I think Bob Dylan, on this particular slide, he summed it up in that very, very famous song of his. That the times they are definitely changing in terms of the stresses and strains that we'll be facing in 22, which we didn't have in 20 and 21. I think also what is very important to understand is that the stocks, and I always re-emphasize this, the stocks that go into our investment baskets, which are blended together by IDAD, our structure, as well as the investment bank, there's an incredible amount of work that goes into it in terms of there has to be a win-win situation, for the bank, there has to be a win-win for our clients, and it has to pass muster, if I can call it that, with all the regulatory bodies in terms of the platforms we use, the regulators in the various countries that we all sit in. Chad will allude to that right at the end. So there's a lot of robustness that goes into these products. And I think in a changing world, which has got horizons that are a little bit murky at the moment in terms of will there be another strain of the variant, or another variant of the pandemic? Will there be interest rates that go absolutely crazy? Will the recovery stall? Will there be a great reset? People are talking about this great financial reset, the banks collapsing, etc. So there's the realm of the extremes, and then there's reality in which we live in. I think it's always good to keep an eye on both extremes, because out of those extremes, there are obviously trends developing, and we need to be aware of that. And those trends we obviously saw coming out of 2020 and 2021, where it was highly digitized, highly tech, etc. So I think this is quite an interesting slide, because it also shows a little bit of the journey of Cashbox against this landscape of a changing horizon. So 2019 was pretty much, we could, because the markets were pumping along, life was good. In fact, there was talk about recession at one stage because things had got so overheated, and before interest and inflation kicked in. So 2019 was a great year to make money, and it was quite. Graham can attest to this because he's at the sharp end of the stick. Putting together those institutional level types of predictable income was I won't say easy, but it was fairly easily achieved. 2020, obviously, the world changed. That was a great reset for me. But within that, of being prudent, of doing the right selections, we had the opportunity to produce absolutely amazing notes that would carry 16, 18% income returns per annum in, let's say, in US dollars. But that was when the markets were coming absolutely off the floor. Everything had gone down that mine shaft in February, March of 2020. And there was only really one way up. It had pretty much bottomed out. The big question was it going to be just a false recovery, or was it going to be a strong, broad-based recovery? It was a strong recovery, but it wasn't broad-based. It was very much in the tech space, the digital space. So a lot of the market was left behind. So as things really got going, and there was great results, and a lot of our products had very short durations in terms of their longevity. They were auto-calling after 6 and 12 months into 2021, because we were coming off such low bases. So we've actually got quite a low duration in terms of how long the notes have been running. And then 2021, we started introducing growth, where you had, instead of the coupons paying out, it became an accumulating coupon. So it was rather paid out as growth. And then 2021, last year, we saw a combination of the two, where we decided let's see if we can provide a regular, predictable income stream, and at the same time creating this almost like a bonus feature of a really attractive payout when the product actually calls. So you had return intra investment, and then obviously on either AutoCall, the maturity, if the conditions were satisfied, you would receive an attractive coupon. So what that left us with coming into this year, and to answer your question, Ray, is that we thought we probably as a business are going to remain with these challenges and these headwinds, and they're definitely there. And although it's more normal, I think we are going to be prudent in terms of looking to create big, solid notes that have great opportunities of return in all those spaces, in income, in growth, and the hybrid, the mixed income and growth. So it's a great mix in one's portfolio. And then this particular product was underwritten by the bank, by BBVA, the Spanish multinational investment bank. And essentially what this is it's completely different to the other notes that you've been exposed to, because it is a guaranteed income. In other words, it's a bit like signing up to a fixed deposit where you know what you're going to get. And it's written for a period of time, let's say for this instance, it's 4 years. And the only way it can be disrupted is if there's an AutoCall, okay? So in other words, you've pretty much signed up to 10% per annum. The first AutoCall is from the end of the 12 months. So that's 10% from the first year. If it had to call then, and Chad will go into these details, then that's what you'll have had. If it runs to 4 years, well, then you've got 40%. But it's a lower coupon. It's 10%. We're not looking at the coupons that we were seeing, as I mentioned, in 2020, we were getting 14 and 16%. We're tempering back. And I think going forward, and this is only US dollar option, you'll see a little bit in GBP, you'll see GBP and other US dollar products in all these spaces, all these sort of shapes and forms of pulling back a little bit. And then there will be those spicier ones that come out that have got perhaps a higher return, but certainly they've probably got a higher volatility in terms of how that underlying basket behaves. I think this is a year of consolidation as we move out of these two terrible, well, certainly the one terrible year and the second terrible year. I'm talking about an investment perspective, not from the emotional quotient that's gone with it. And as we go forward, this is a great opportunity to lock in, great levels of income. You certainly can't get 10% per annum in a US deposit anywhere. I can tell you that straight away. So let's go into the blend. Some of these you'll be aware of. Some of the names are household names. Some of you from the States might recognize Dex and Peloton. But let's start with Nike. Nike is and we're going to go through some charts as well, but I'll just run through these briefly. Nike is not a small company. It's got a market capitalization. In other words, what it's worth is around about just under 240 billion US dollars. So just shy of $250 billion. So that's a substantially sized company. It is the largest sportswear apparel company, designer, manufacturer, and distributor of sports equipment in the world currently. And it's also a constituent of the Dow Jones, of the Dow 30, that Dow 30. So it's a heavyweight company. It absolutely knocked the socks off in its Q4 earnings towards the end of last year. Was rewarded, and more recently the prices have come off. Now we will want the prices to come off. We'd like to have a lower entry level, and that's specifically applicable to Peloton, which I'll go through last. Adidas, it's staying in that same milieu. Adidas is a German multinational sports shoe. That said, it's part of the DAX 30 index, so that's the equivalent German index of the Dow, based in Frankfurt, which is also its primary listing. Started way back when in the mid 40s. It's got a market cap way less than Nike, of about just under 50 billion euro. So also a fairly substantial company. It's got some very famous names that it's subsumed under there. Reebok is probably the most famous. And it's the largest European sportswear manufacturer, and obviously, as I mentioned earlier, it's a second to Nike in terms of its size. So, household names, this is something that resonates with us in all our products. We always look for well-managed companies, great balance sheets, histories, management teams, leadership teams, etc. Dick's Sporting Goods, interesting company. It's listed as a Fortune 500 company. It's got over 50,000 employees. It's a giant sporting goods retailer in the US, primarily the US. It's got a small market cap by comparison to the other two previous companies of just over $10 billion. And as I mentioned, it's got a pretty large staff complement. So it's widely spread. So it covers all the various sporting codes, whether it be mountain climbing, mountain biking, fishing, running, hiking, shooting, sportswear, you name it, it's the A to Z. It's your go-to shop. And we'll have a look at some of the charts next. And I'll deal with Peloton lastly. Peloton it's some it might be very well known. It was the poster boy or poster girl or poster person. I've got to be careful. That was my binary language. It was the poster child of the pandemic in terms of success, but like Zoom, which basically they were in the right place at the right time. Their share price went absolutely astronomical when people realized that they wouldn't be able to exercise, stay fit, keep healthy. They'd have to do it on a remote basis from their lounge, wherever they were staying. And the share price reflected an absolutely astronomical steep rise. And what's happened since then? This is the reinvention of companies. I mentioned earlier, Tesla got to astronomical sort of valuations. Peloton got to a valuation that we felt also uncomfortable. I didn't look at Peloton last year because I thought as we come out of the pandemic, it needs to reinvent itself because people want to get on their bicycles on the road and go through the forests and go on trips. They wanted to get onto the road and run, not on a treadmill. So we've waited, I think, carefully. We started using Peloton and Grant's going to tell us earlier in the year. And I think specifically now, it's sort of in the right space from a valuation perspective. If we look at the top 40 brokerages by Bloomberg's, their recommended price is somewhere between $30 and $38. And it's sort of sitting right in that at the moment. So we believe that the steep devaluation, the steep sell-off that they've had this year puts it back into a place where it should be. I don't believe it was sustainable at such a high rate. And certainly Peloton, this time last year, I would have been very cautious of. So we started using Peloton. It's if I can call it, it's the spice amongst the three. And it certainly allows us to get in a slightly better coupon rate than you'd get in cash, for example. But it's at the right rate now. So I think, Jill, if we can just go to the next slide, it'll show you some of these charts that I've been mentioning about. So there you have your Adidas, you have your Dick's. You can see great performance over the years. Specifically, you can see what happened during the pandemic. So if we go back to when Cashbox started looking at these and going into the community, it's been a good place to be in those particular shares. I'd like them to come off a little bit before the 26th of January because the lower the entrance fee, the better the chance for an AutoCall for that. For those clients who don't want the AutoCall and they want to lock in 10% for the next 4 years, it can stay as you are. If we can go to the next slide quickly, and that'll just show you why I was cautious of our friends Peloton. So there's Nike, fantastic company. I was interested to know, and maybe some of you do know, while I was doing some research on it, I wanted to find out the meaning of the Nike swoosh, their sort of logo that's on every single shoe that's stitched on, and it's actually the Greek winged god of victory. That's the word Nike. That's where the word Nike comes from. But the swoosh is actually symbolic of a wing attached to this flying goddess, signifying momentum, strength, speed, integrity, and intensity. And certainly their results are there. They've come off a little bit this year because everybody is expecting that, well, if there are going to be interest rate increases around the world, disposable income comes off a little bit. And I'll come back to that when I finish with Peloton. Peloton, you can see, went up dramatically, and pretty much since then it's been in a bit of a decline. So, yeah, I think I take comfort in the fact that 40 of the top analysts, brokerage houses, Wall Street, etc., are comfortable that it's in its range. And the reinvention of the company is very important. They'll be doing quite a lot of surgery to their offering, how they do it, etc. Now, I mentioned something about interest rates with Nike. It applies to all these. They're in a sector, these companies are based in a sector known as discretionary consumables. I'll just give you, it's discretionary because you don't have to buy a set of trainers or an exercise bike. You don't have to. Whereas non-discretionary staples, for example, would be a company like Nestle or Unilever who are producing foods, everyday staple supplies. So discretionary is where it's important to understand that when inflation is very low and interest rates are very low, people will spend and they'll go out and buy goods and services because they've got the affordability. So as that handbrake gets pulled up, the party for free money is over, interest rates get moved out, inflation rears its head, and interest rates will temper that. The supply blockages will ease. So, a year out, we look at the forecasts for a year out of these companies, and they very well certainly could be beyond their starting points. And that's when an AutoCall would come in and interrupt the supply. But if it doesn't happen, there's a guaranteed income component at the 2.5% per quarter. It just gets paid. So fantastic fixed income type of opportunity that can go into your fixed income part of your portfolio. So if there's a cash component requirement, this is a great opportunity to fulfill that situation. If we go to the next slide, which is really just a recap of everything I've spoken about, and I'll deal with one in particular, which is the issuing company, because that's where risk lies. This company has underwritten this product at a much higher premium to market. Graham can jump in on this because I worked with him on this, and he gave me some really good insights into BBVA. And I'll let you jump in shortly, Graham, but BBVA is a big multinational bank headquartered in Spain, but very active in Latin America and across Europe. One of its lesser known facts outside of Europe is that it sponsors one of the big soccer tournaments. There was a co-sponsor, La Liga. And you can see the terms and conditions there. It's guaranteed income. It's 2.5% per quarter. The term is 4 years. The AutoCall trigger is from 12 months, and it's 100% from starting. So if those 4 shares are equal to or greater than their starting price, in a year's time, this product will end, okay? Your full capital will be returned as usual, and you'll have benefited the 10% coupon paid quarterly. The reference basket we've run through, but I would say go back and have a look at the rationale that I put together on our website. It takes in a little bit more detail, and you can nitpick, and please reach out to us if you'd like to. Capital protection, we always use capital protection. We always make a point of this. The term is underwritten, and that's why we choose tier 1 A-grade banks for the integrity that S&P, Fitch, and Moody's, the big credit rating houses, have given it their A rating. That's very, very important. And certainly the capital protection, really, it's through term, but it's at risk, as we always say, at the very final observation, the 16th observation, which is 16 quarters. If any one of those stocks has dropped below its priced by more than 50%, then it's capital risk. Chad's got a nice little graph at the end to distinguish how that all works. And the availability, as always, it's an open.
There's an error on there. I just saw it now. Its closing date's 26th of January, not 28th of September.
It's a long subscription.
I'm working on the phone. I'm working on a phone with my 1.5 bifocal, so I didn't quite see that. But yeah, it always is a first come, first serve basis in terms of, and I'll hand over to Graham for his 5 pence worth or 10 p's worth, is that the bank always creates a tranche of availability or inventory, as they call it. They don't generally go beyond that. Sometimes we can squeeze them in a bit of a gentleman's agreement for a little bit extra. But what we've normally, Graham secures us a good slug, normally between 250 and $1 million US dollars, for example. And in this case, we have pre-sold already some of it, but there's still availability. And we can always prevail on Graham to lean into the BBVA guys. Graham, would you like to say a few words just on maybe BBVA, because that's important, how they can offer this premium at a higher level than what the bank would ordinarily pay out on a fixed income deposit.
Yeah, I mean, once again, Andrew, you have so clearly and concisely covered so much of the note. It's phenomenal. I mean, one of the biggest things for me is the ability to be able to concisely and very eloquently, communicate what a note will do. And so you've clearly done that. I'm super impressed with the way that you very modestly have not attributed any of the pulling together of this from your own sort of resource and ability and analysis. It's been great that we've worked together on this. And to very swiftly push into the issuing bank. I mean, Banco Bilbao Vizcaya Argentaria is a gargantuan investment bank. It spans the globe. It has a lot of interest in South America, but it's equally as very interested in Europe. Obviously, it's Spanish origination. Its involvement in China, in Turkey. It really is global. Andrew mentions about the risks related to the issuing bank, the investment bank. I mean, we as IDAD, we always vet all the investment banks around the world. Not all investment banks want to work with a company like IDAD. We're quite fortunate in the sense that our credentials allow us to walk in the door and sit down with the senior executives of these organizations, JP Morgan, Goldman Sachs, HSBC, Barclays, whoever you want to mention, BBVA. We can and we do, and we work with them and we monitor them, and we only deal with the best. There's plenty of investment banks in Europe that maybe have 2 or 3 extremely wealthy shareholders, dare I say a couple of oligarchs in there as well. But we wouldn't deal with them because it wouldn't be appropriate, because the risks involved, should any one of those shareholders decide they've had enough and want to pull the plug, we don't want to be in that space. We don't want to get involved in that. So as I say, Banco Bilbao Vizcaya Argentaria is a huge organization. As Andrew mentioned, it's equivalent of Barclays to the Premiership. It sponsors La Liga in Europe. It's got over a 16 billion market capitalization. Its employees are, as I say, spanning the world. Very, very concisely, Andrew touched upon it very well, in the sense that BBVA has to balance its books. It has a balance sheet that has to work correctly. It's taken a tremendous amount of interest in the ability of organizations around the world to move forward, not only from this pandemic, but also in this current environment that we are in the 2020s of our time as mankind. And so therefore, there are huge projects across the world that are taking place: infrastructure, investment, reinvestment in existing organizations that haven't invested for maybe 10, 15 years in their global operations. So BBVA has been doing an awful lot of lending that is extremely well controlled, demonstrated by its capital tier 1 ratio of 13.6%, which again is a result of the credit crunch, whereby organizations were forced effectively by governments and regulators to ensure that we didn't have a repeat of the 2008-9 credit crunch. And so the strong balance sheet requirement, the capital tier 1 ratio that BBVA has to be met, and indeed is. But at the same time, the investment bank has the ability to garner cash flow into the business under obviously strong compliance and risk control scrutiny to be able to operate and balance the books. And so therefore, here is the opportunity where we sat with BBVA. Obviously, Andrew and I discussed matters. We played around with a few ideas, and then IDAD went to BBVA and said, look, we think we've got something here. They obviously crawled all over the idea, and they thought, yeah, we're happy. We'll go with that. We, as IDAD, as an organization, squeezed the coupon to the maximum, as we always do, for the benefit of the end investor. And so therefore we have a guaranteed income of 10% per annum. which I think is fantastic. To be able to sit back and see that in your portfolio. I'm a great believer in that only promote what you believe in, and I'm sorely tempted to participate in this as well. Unfortunately, my portfolio is so full of structured notes that it's difficult to find space. But nevertheless, Andrew has eloquently touched upon things. I think I'd like to just re-emphasize the Peloton perspective. I think that is perfect for this note. There's no question about it. Peloton is the stock that you would look at and say, really? And as Andrew has quite rightly stated, Peloton is now where a lot of the market traders believe it should be, but has the ability to grow as well. Still, they are performing a tremendous amount of software development within their actual product, so that they can engage more with the customer. It's amazing to note that some of the trainers in Peloton are earning six-figure sums. Most of them are earning six-figure sums because the engagement is key. Andrew's absolutely right in the sense that we see the back of this pandemic. People will want to be out on bikes that they can actually pedal outside in forests, over mountain tracks, etc., on roads, rather than being stuck in their lounge or their gym room or whatever. But still, I believe Peloton has the ability to engage through their innovative software, to engage trainers. Individuals want the training experience to know that they can push themselves more. And so Peloton is developing all of that, which will most definitely allow the company to grow, expand, and increase in what it's offering, with further developments down the road. So I think the final point I would say that as Andrew mentioned again, the idea of regulators being involved in areas like this is so important, and it's always a pleasure to be able to state, and I do state it repeatedly, that IDAD is only one of the few FCA of the United Kingdom, the Financial Conduct Authority, directly regulated structured product provider that operates globally. So we have an enormous amount of compliance and responsibility to ensure that our status is always at the actual peak of requirements under the parameters of the FCA. And so therefore, and that filters through everything, as I say, through our analysis of investment banks, through our strict criteria on who we deal with, who we don't deal with. So yeah, I wholeheartedly support Andrew's comments on everything about this note, and I think it's great that he's been able to input and help us develop this.
Thanks, Graham. Brilliant. Chad, do you want to take us through I think the fact sheet is next, just briefly.
Yeah. Cool.
Pull that apart.
Excellent. Hello, everybody. If there is anybody online that would like any further detailed training, etc., please reach out. I'm going to run through what's in the fact sheet just in brief and how the product is set out. But if there's anybody online that would prefer deeper training, it's gladly available. So the first thing that you'll notice is the issuer is listed here as BBVA. This is their fact sheet. They're underwriting it. They're guaranteeing it off their balance sheet. And what they're seeing is strength in these particular shares that would more than adequately cover their cost of capital. So they plan to make more than 10% in order to pay us the 10%. So they are that comfortable with these underlying stocks. The strike date is the 28th of January, not September. So we would need the funds through your platform by the 26th of January in order to make the particular product. So if you flip to the next sheet, please. What you'll notice, there are the 16 observations, and in this case, there are no observations required in the first 3 observations, meaning that your income will flow no matter the level of the product or the underlying assets. So no matter where the shares are, they are guaranteeing to pay us 2.5%. And let's say by observation 4, this time next year, the 30th of January 23, should all the shares be above 100%, in other words, above their start price, the product is able to mature early. So what does this mean graphically? Will be the next graph, if you don't mind, Jill. So we're going to have the start date, and the shares will be measured at 100% of their start price. As the quarters flow past, so the bank is going to guarantee us, has guaranteed us to pay us 2.5% on the passing of quarter 1, quarter 2, quarter 3, quarter 4, no matter where the underlying stocks lie. However, from quarter 4 onwards, you can see the AutoCall barriers or level has been put in place at 100%. So the stocks need to only carry on at their start price. If they are at their start price at quarter 4, the product will close early. It will pay back our capital to our investment platform and the last coupon. So we guarantee 10% for the coming year. How long the product will go depends on when it would AutoCall. And then because of the amount of work that's put into these products, folks, as you know, over the past 5 years, 100% of all the investments have AutoCalled earlier than their final date. So it's highly likely that this product would AutoCall within a year. And then built into the product is our capital protection barrier. So that's the red item at the very last observation. So long as the stocks are above 50%, they've halved in value, as long as they're above that, our full capital will get paid out. So where in the world do you go and invest for this level of steady defined income and also capital protection? This is why we love these products. So Andrew and Graham, great job here. Mm-hmm. If there are any questions, please shout out. Otherwise, I could move on to the next slide. As we've said, folks, we would only ever work in a highly regulated environment. We worked hard enough to create income or our capital. Let's make sure it's protected. That's why everybody in our environment is highly regulated. And of course, folks that may be new to this, the only way to get to these products is through a regulated investment platform. If you need help with any of this, please reach out. We'll gladly help you with that. These are super platforms, 24/7 visibility. You can run an entire portfolio on these platforms. Really, really well done. Thanks, Jill. And then what's interesting, folks, through IDAD, these guys are creating around 200 structured products a year for the last 5 years. We are running at around 10% of that as the Cashbox community, and everyone is designed as performed. It's tremendous to have investments designed in this level of protection and with this amount of detail in it. Thanks, Jill. And then, folks, if you have any questions you'd like to ask us directly or in the chat group now, please let's open it up. If you do want to reach out to us directly, our email addresses are very simple. It's support@cashbox.global or Andrew or Jill or Chad at Cashbox Global. If you want to follow us on LinkedIn, we put out regular information. Otherwise, the new product is on the website, the rationale, the fact sheet, and more of the details if you like. And there's also the training modules in there. I hope that covers it. If there are any questions, folks, do you want to reach out now? Yes, Dawn, the minimum is $10,000 and this product's available dollars only.
If I can just add to that, sure. Chad, sorry, the minimum is $10,000, and obviously there's a point that you need to also reference your platform, which obviously Jill and the Cashbox team will be able to help you with, because they presumably have parameters as well. But I would also say that beyond 10,000, the investment levels must be in lots of 1,000. Yeah. And so, you know, that's a very you know, I think it probably is something that excites you so much, Chad, in the sense that, you know, here you have an institutional investment proposition that is at a relatively accessible level for a large portion of society, which is great.
Graham, that's really, I think, the part that's excited Andrew and I, and Jill, of course, is here, instead of 250 to $500,000 just to get a bank to be interested, we can offer it at much better levels. And of course, what that does is it gives us an ability then to create a portfolio of structured notes.
Indeed.
Which our community has been enjoying. So last year, we were running the numbers today, we were averaging over 15% as an annualized return in dollars from protected, predictable income streams and growth.
Fantastic.
I mean, try and find a fund manager to beat that. Yes, pound was slightly behind that because of the bond rates, and euro a little bit behind that again. Yeah, but nonetheless, it's been a great run for the community.
Yeah, and I think to add to that as well, I mean, one of the points that Andrew made which I believe was in your invite to this webinar, was that worst case scenario on this particular product is you go 1 year and you get all of your capital back and you get 10% return. I mean, that's a worst case scenario if you want to deem it that. Otherwise, you sit comfortably for 4 years and receive 40% over 4 years, and then you get your capital back. As obviously, if the 50% capital preservation barrier hasn't been breached, which again, we could spend an inordinate amount of time on how powerful that 50% capital preservation barrier is. But stunning, absolutely stunning.
I was actually chatting to Andrew on the subject just yesterday. Maybe Ray, to one of your questions is, what else might live in an interest environment like financial services, et cetera. And what's amazing with this AutoCall feature and the product coming out, and our average has been just over a year and a bit over, we can keep reinvesting in what's appropriate at that point in time. That is so powerful.
Yeah. I mean, the ability to lock in for what is a contractual term, but also have the ability to then step out in accordance with the AutoCall parameters is a flexibility that I think is just one of the USPs of structured notes. And there's not just the one. It is phenomenal.
Great. So Annie, thank you for your question. How do the fees work? So the great news is Cashbox gets paid a raising fee from the bank for aggregating and bringing the deal to the bank. So let's say you were going to put in $20,000. Your full $20,000 would go into the product, and the bank would pay back to your platform the 2.5% every quarter. The only fees you would be subject to then would be the fees that the platform would charge for holding your account for the year. We can gladly take you through that. And the platforms that we work with are fee light, a fraction of a percent, and what we're able to do then take you through how that would work. So what we love about this, it's fee light, return strong in its structure. So if you want to chat separately, Annie, I'll gladly take you through that if you'd like. Ray, did we answer your questions, or would you like to ask some more? Because you got some lovely ones there.
Just a quick question on another thing. The last few notes have all been BBVA notes, and I know that BBVA is really good, but I don't want to put all the notes via one bank, because effectively you're lending to a bank only. Are you going to be doing more kind of in the future with other banks, or?
Andrew and Graham, I think you best.
Yeah, I'll maybe step in quickly before Andrew gives you the Cashbox perspective, which is fundamentally the most important, to be honest. but if I can just give you feedback from IDAD, Ray, and that is that we do at any one time monitor approximately 27 to 32 global investment banks around the world. BBVA is one of them. And so therefore we are constantly dealing with all of these banks. Now, What we do with Cashbox is that Cashbox and IDAD work together to produce notes that are specific for Cashbox client base. And so therefore, Andrew and I sit down, we look at things and we work something out. And then IDAD goes away through myself, and we then sit with an investment bank and say, right, this is what we want. So really, there's a few things I just want to mention to you. Number one, BBVA at the moment, and indeed for the last, I'd say 18 months, 2 years, has been incredibly competitive in the marketplace across the board, whether it's a growth note, an income note, any type of, an indices basket, a stock basket, whatever you want to look at. BBVA is without doubt right up there, the most competitive. The second point is that what we find with some of the other investment banks, and I won't name names, but think of them, Goldman Sachs, Morgan Stanley, whoever, they have very large exposures to certain parts of the world, to certain sectors in the world, et cetera, et cetera. So they're quite restrictive in what they'll allow us to do within a basket. And so therefore we find that quite inhibiting, because we want the best for the end investor, that without doubt, that's our overarching factor. And so therefore, really ultimately, and I would say the third point is BBVA really, really like IDAD. We get on well with them. We're very relaxed with them. It's not a difficult or awkward relationship, which can occur with these investment banks. And so we with a combination of all that, we are developing the best we believe in the market. Now, I absolutely agree with your observation that you can look at your portfolio and you can say, well, hang on a minute, I've got a very large exposure here to BBVA. Now, we do take that into consideration, and most certainly Cashbox will, without doubt. And it is a factor that we're looking at all the time. However, I would say that, because we are dealing with the best of the best, we are not exposing you to an organization where we feel that you are putting all your eggs in one basket, and if everything goes pop, then that's game over for you. As I say, we are dealing with the best of the best. This is a highly credit rated organization. It has strong capital tier 1 ratios. It's highly regulated. It's got a global footprint. We as an organization, as IDAD, are constantly tested by the FCA in the UK as to how we are operating as a business. And at the forefront of everything is TCF, treating customers fairly. It's about risk and control. It's about compliance. So we are constantly testing all of these parameters. So certainly, it's a great observation, and I 100% agree with you. To have one investment bank effectively as your exposure. But at the same token, I would also say that be rest assured that organizations behind the scene, i.e. Cashbox and IDAD, are constantly monitoring that status on your behalf. So it's a balance. It's a balance, Ray. It's a balance of, do you want a Morgan Stanley note that gives you half the return? But you know that you've got a Morgan Stanley note in, again, with BBVA products? Or do you want what we are producing as the best in the market with the risk and controls that we apply to ensure that you have the best product that we can deliver to you? Andrew, I'm sure you've got further to add.
Yeah, 100%, Graham, and great question, Ray. It's obviously with diversification, whether it be a bank, an issuing bank, whether it be an asset class, whether it be an economy, a demographic, or geography, there's always got to be that diversification. And I know, Graham, and when we go, I call the word hunting, please, I say it in the best possible way. Yeah. When we go shopping for the note, in other words, we don't just approach one bank. They'll go to a number of different banks who will put it before their credit committee, before their investment team, so that it makes sense. And we don't just literally always take the top tier number. For last year, for example, we had issuances through BNP Paribas. We had issuances through Goldman Sachs, and sometimes it's a result of a particular quirk of the bank. In other words, Goldman's, for example, are a very particular. Goldman's is a Wall Street bank, but their investment bank is based out of the UK, out of London. So they've got these different balance sheets that they move around, and sometimes they'll be very aggressive. And you might find, for example, Barclays or Rabobanks or Nomura or HSBC will suddenly come to the party, and you'll have a better opportunity. But as Graham has articulately pointed out, the last probably 12, 18 months, and it's shown in their investment banking returns as a business, they've been incredibly profitable. Yes, aggressive is one word, but they've been extremely profitable to their shareholders. And to maintain that Fitch, S&P, and Moody's rating is very important. But we are always looking for opportunities. Chad and I had a really interesting discussion, and it's been fed through to Graham and the Chief Investment Officer of IDAD, that we're going to be looking for some interesting sterling opportunities. We had some great issuances last year and the year before. Barclays did one, for example, and there's no reason why any of those investment banks, if they come to the party and it's right for the client, it's the right product, that we won't go with them. So I remember we did one recently for BNP Paribas, and just as an example, BNP, big French, also global company, but they've got a strong relationship with the Far East, for example. They do a lot of lending there. They do a lot of financing in the Far East, for example. They've got a cultural connection through the old, whether you're good, bad, or ugly, the colonial era where they had interests there, geographic and economic and political interests. Same for West Africa. BNP are very, very, very strong in issuances relative to where Muslim law might be involved. So sometimes it's a case of picking the right horse for that particular race, if you want to call it that. But often we will come back and we'll analyze. We've got on the table Goldman's, JP Morgan, Barclays, HSBC, and BBVA, whoever it might be, and we'll choose the right one. It may turn out that we choose none of them, simply because the payoffs aren't right, or the term isn't right for us, or it doesn't agree with our bottom line mantra, which is we want to go out and get the best possible protection. So, I say to Graham always, we've got to try and chisel these guys down and get the pencil sharpened down, so we got the deepest levels of protection at that institutional level. And some of the banks are, you must understand, some of the banks are very greedy. Investment banks aren't charities.
Yeah.
So if they can weaken the protection barrier, that means they're getting a few basis points back in their back pocket. So it's a game of negotiation. And all kudos to the guys in London, the IDAD team, who go out there and talk the tough talk with them to get those T's and C's ticked off. Because if an investment bank can make a few bips here and a few bips there, they will do it without blinking. So so I think the relationship is very good. It's very strong. But certainly towards the end of February, I beg your pardon, towards the end of all these dates are we getting wrong, towards the end of January, early February, I'm hoping that we can put out a really, really interesting sterling-based, probably US dollar as well, but sterling-based opportunity, which might be in the space of, this inflationary interest rates, dark waters, murky horizons, where are we going? So, what would be the great sectors there? So the great sectors there historically, as I mentioned in my sort of spiel, if I can call it that, we're going back into more ordinary times. So what does well in high rising interest rates? Banks, for example, banks and staples that are inflationary and interest rate proof. You still got to bank, you still got to eat, those type of issues. So we went into banks, for example, through a number of different issuers early last year, and during the course of last year. I think with the exception of one, and I think we had, Graham, about 4 or 5 issuances of different banks. They've all auto-called. Yeah. Because we were actually really ahead of the curve there. And if you look at what banks have been doing in the last month or two, with all this talk of interest rates over December and January, they've done really, really well as a sector. So the banks themselves, in that sector issuing these products are very aware. So we will be, again, shopping for, certainly the sterling-based one will probably have a lot of FTSE components. So it might be very well issued out of a UK bank, out of Barclays or Lloyds or whoever, or Lloyds not an investment bank anymore, but certainly Barclays, HSBC, or any of the other big banks. And we will determine and get for our community and clients, ultimately the best deal. And that doesn't mean actually that we're just going to take the top number. It what makes sense in all the terms and conditions, all the payoffs, that it sits well with us, and it will sit well in a portfolio.
Yeah, and I think just to add to that as well, and I may be going on a bit of a tangent, but I think the other thing, Ray, as well, is that IDAD deals. Obviously, we're delighted to be dealing with Cashbox, but we deal with fiduciaries, we deal with wealth managers. We deal with trustees, and obviously Andrew has a very familiarity with that. But their criteria is as powerful and as stringent as an individual is with their own portfolio. So a trustee will sit there and say, well, I have an obligation here. I have a fiduciary responsibility to this trust that I cannot allow.
No problem. I've got to talk to my trustees. And
yeah, exactly.
So this is exactly where I'm coming from.
Yeah.
I like BBVA. It's a brilliant bank, but put all your eggs in one basket is always a bit of an issue.
This exactly, Ray, and I'm glad we've touched upon that, because IDAD is constantly challenged with that parameter, as I say, through all of the organizations we deal with, as well as life companies. So life insurance companies, they also have parameters. They have their parameters that state that certain baskets aren't acceptable, certain levels of capital preservation have to be achieved per stock that's included in a basket, so on and so forth. So we have to operate in a very, very sort of rarefied air to be able to deliver what we want to be able to deliver for the end investor to have the best of the best. And so, I suppose my final message is absolutely agree with you. We must look at diversification. We must look at concentration within portfolios. But at the same token, we always have the best interests at heart of the end investor.
Thanks, guys.
Thanks, Matt.
Ray, anything else you'd like to cover? Any other ideas or sharings, maybe?
No, I mean, I guess my other question is, are we going to just see income notes at the moment, or are we going to have the hybrid things again and different ones, or growth notes? How do you think that's going to pan out this year?
I think, Ray, we could see all of the above.
Okay.
We're moving into areas where there will be growth. As I mentioned in my talk, I think it's going to be harder to define who are going to be the out and out clearly defined winners in terms of investment baskets. But I think there are going to be strategic opportunities that come along. They come along every year, which are absolutely almost no-brainers. An example of that was in 2020. So it's a little bit technical, but the oil futures price absolutely collapsed around the world, and it went down to $30 a barrel, literally in the space of 2 weeks. IDAD, and we got a note together. It was very short. It only lasted 6 months because it was on a monthly call. But I think, Graham, correct me if I'm wrong, I think the guys made 1.5% a month. They made 10% or something in 6 months. But that was very specific to an aberration in the market, which we all knew was going to come back. It just was how long it was going to take, like 6 months or 12 months. So there will be, I believe there's going to be an absolute blend in terms of income as a staple. There'll be growth as the hybrids and maybe these slightly sexier, fizzier sort of tactical opportunities. But we'd like to put out a staple of, predictable, strong growth, strong income, or hybrids as and when it's needed.
Yeah. And then, Ray, what we could gladly offer, if you have anything particular you're after, let's chat, because these are all options that could be produced.
Okay. Yeah.
Yeah.
Great.
Yeah. If I can add to what Cashbox have mentioned there, Ray, I wholeheartedly support what's just been said there. I mean, IDAD as a business has a global reach, and we are offering structured notes into the international marketplace around the world. And so therefore we have a particular style of appetite that might come from Asia, which tends to be a little bit racier. So they'll be chasing some digit returns that that are really quite up there, but won't have a capital preservation barrier of 50%, because they'll want to take that additional risk to get that higher coupon. And then we'll have a certain type of demand from South America that's quite commodity orientated. And so we'll be looking at baskets that are very much around ores and minerals, etc. And then we've got the European market, which is quite staid, which is quite which is much more reserved, and is quite, and I'm quite open to say it. Individuals will be quite happy to receive anywhere between 4 and 5%, but they'll be looking to have massive controls on their capital preservation. I mean, what Andrew's mentioned there in what's going to be offered is with undoubtedly going to be an array of styles and shapes that we can build with Cashbox. And I would add to that we might just possibly, let's hope, we might even get back to a period where we can offer capital guaranteed products, which Andrew will attest to the fact that I've almost forgotten about what they look like because the market's been so difficult. But we may well get back to even a capital guaranteed note. But don't hold me to it just yet.
Folks, thank you so much. I think we're at the hour. Sorry, Ray, did I cut you off? I beg your pardon.
That's fine.
Could you repeat?
So I think, a good mix of notes is healthy, and is, you're going to get all sorts of different levels and different income types and growth types. And I think that's the best way of doing it.
100%. Totally agree with you, Ray. No, I've been a massive fan of the idea of building in staged quarterly returns with a mix of income and growth, along with that strong capital preservation. I mean, you can actually build a portfolio where you see every month you either get a capital attribution, or you get through an AutoCall, or you get an income delivered to your account. I'm absolutely with you on that one. Yeah.
Yeah, thank you.
Excellent. Well, folks, thank you very much for your time. If there are any more questions, Jill has put in an email address at the bottom. Love to chat always. Graham, thank you so much for your time.
Absolute pleasure.
Thank you for the most amazing product as always. Jill, thanks for looking after the community. And to everybody else, thank you for your time. Lovely to see you.